Imagine you're standing on the floor of the New York Stock Exchange. The year is 1987. Traders are shouting, waving paper tickets, running between desks. A single trade might take several minutes to complete. Now fast forward to today. The trading floor is nearly silent. But don't let the quiet fool you beneath the surface. An invisible war is being waged at the speed of light. Welcome to the world of high-frequency trading, where computers execute millions of trades in the time it takes you to blink, where a single millisecond advantage is worth millions of dollars, where the real action happens not on trading floors, but in secret data centers located as close as possible to the stock exchange's computers. This isn't the Wall Street you see in movies. This is the Wall Street few people ever get to understand. And today, we're pulling back the curtain on the secret systems that actually run the financial markets. Let's start with something that sounds almost impossible. There are trading firms that will pay millions of dollars just to shave 3 milliseconds off the time it takes their trade orders to reach the exchange. 0.003 of a second. Why? Because in that tiny fraction of time, entire fortunes can be made or lost. These companies build what's called co-location facilities, essentially server rooms located within feet of the stock exchange's matching engines. The New York Stock Exchange has one. So does NASDAQ. These aren't ordinary server rooms. They're precisely climate-controlled environments where temperature fluctuations are measured in fractions of a degree, where backup power systems can kick in faster than you can say the word blackout, and where security makes Fort Knox look casual. But here's where it gets really interesting. Being close isn't enough. These firms obsess over the length of the fiber optic cables connecting their servers to the exchange. They'll pay engineers to measure cables to the millimeter, because even the physical path that light travels through fiber optic cable matters. Some firms have even explored using microwave transmission towers, because microwaves travel through air slightly faster than light travels through fiber optic cables. They've built networks of microwave towers stretching from Chicago to New Jersey, over 700 miles, just to gain a 4 millisecond advantage. Think about that. Companies are spending tens of millions of dollars to save 4 milliseconds on a trip that already happens faster than you can perceive. This isn't just about being fast, it's about being first. So what exactly are these algorithms doing? The strategies are incredibly complex, but let's break down a few that dominate the landscape. The most common is called market making. In simple terms, these algorithms constantly offer to buy and sell stocks, profiting from the tiny difference between the buying and selling price, the spread. They might make just a penny per share, but when you're trading millions of shares per second, those pennies add up fast. Then there's arbitrage. These algorithms scan multiple exchanges simultaneously, looking for tiny price differences in the same stock. Maybe Apple is trading for $150.00 on one exchange and $150.01 on another. The algorithm instantly buys on the cheaper exchange and sells on the more expensive one. The profit per trade might be microscopic, but these algorithms can execute thousands of such trades every second. There's also something called order anticipation, which is where things get controversial. These algorithms try to detect large institutional orders, like when a pension fund is buying 10 million shares of a stock. The high-frequency traders spot the pattern, buy the stock first, and then sell it to the pension fund at a slightly higher price. Critics call this predatory. Defenders say it's just smart trading. Either way, it's perfectly legal, and it's happening millions of times a day. But with all this speed and automation comes enormous risk. These algorithms are making split-second decisions with billions of dollars. What happens when something goes wrong? And trust me, things do go wrong. Let me tell you about May 6th, 2010. It was a normal trading day until 2:32 p.m. Eastern Time. Within 5 minutes, the Dow Jones Industrial Average dropped nearly 1,000 points, wiping out about $1 trillion in market value. Stocks like Procter & Gamble briefly fell from $60 to $39.37. Accenture, a major consulting company, traded for 1 cent, 1 penny. Then, just as suddenly, the market rebounded. The entire event lasted about 36 minutes and became known as the flash crash. What happened? A complex chain reaction triggered by algorithmic trading. A large mutual fund used an algorithm to sell $4.1 billion worth of stock market futures contracts. High-frequency trading algorithms detected this unusual activity and started selling too. This triggered other algorithms to sell. Within minutes, these systems were essentially trading with each other in a downward spiral, with human oversight completely unable to keep up. This event sent shockwaves through the financial world. It revealed something terrifying. The markets had become so automated, so fast, that they could destabilize in ways no one fully understood. And it led to a massive overhaul in how trading systems manage risk. Today's risk management systems are like air traffic control for money. They operate in multiple layers, each designed to catch problems the previous layer might have missed. The first layer is at the algorithmic level itself. Every algorithm has built-in constraints. It knows the maximum number of shares it can buy or sell. It has strict limits on how much money it can risk. It monitors its own behavior, checking thousands of times per second whether it's operating within normal parameters. If something seems off, maybe it's losing money too quickly, or it's receiving unusual market data, the algorithm will automatically shut itself down. This is called a kill switch, and it can trigger in microseconds. No human approval needed. The algorithm essentially decides, something's wrong, I need to stop. But what if the algorithm itself is malfunctioning? That's where the second layer comes in. Every trading firm has what's called a risk management engine that sits above the individual algorithms. This system monitors all trading activity across the entire firm. It tracks exposure in real time, how much risk the company has in different stocks, sectors, and asset classes. If any metric approaches a dangerous threshold, it can shut down individual algorithms or even halt all trading instantly. Stock exchanges themselves have the third layer of protection. After the flash crash, regulators implemented circuit breakers across all major exchanges. If a stock moves more than a certain percentage in a 5-minute period, trading in that stock automatically pauses for 5 minutes. This gives algorithms time to reassess, gives humans time to investigate, and prevents the kind of cascading failures we saw in 2010. For the broader market, there are additional circuit breakers. If the S&P 500 drops 7%, trading halts for 15 minutes. If it drops 13%, another 15-minute halt. If it drops 20%, the market closes for the day. These aren't suggestions. They're automatic shutdowns built into the infrastructure of every exchange. There's also something called a limit up, limit down mechanism. It prevents stocks from trading outside of a certain price band. If a stock tries to trade 5% above or below its recent price, the trade is rejected. This prevents the kind of scenario where Accenture briefly traded for a penny. But here's what's really fascinating. These risk systems are themselves a technological marvel. They have to operate at the same speeds as the trading algorithms they're monitoring. They're processing millions of data points per second, running complex calculations, making instant decisions. And they have to be more reliable than the systems they're watching over. After all, you can't have your safety net fail when you need it most. The firms developing these systems employ some of the world's top engineers and mathematicians. We're talking about people with PhDs in physics, computer science, and applied mathematics. They're building distributed systems that can handle petabytes of data, that can fail over to backup systems in microseconds, that can maintain accuracy even while processing information at incomprehensible speeds. And the technology keeps evolving. Some firms are now using machine learning algorithms that can detect anomalous trading patterns that human-programmed rules might miss. These systems learn what normal looks like and can spot deviations instantly. Others are implementing blockchain-like technologies for better audit trails and transparency. The arms race between trading speed and risk management never stops. But there's a philosophical question lurking beneath all this technology. Have we created markets that are too fast for humans to understand or control? When trades happen in microseconds and crashes can unfold faster than any human can react, are we really in charge anymore? Some argue we've made markets more efficient and liquid. Others worry we've built a house of cards where the next major malfunction could be catastrophic. Regulators are caught in the middle, trying to write rules for systems that evolve faster than legislation can be drafted. What's clear is that this world of algorithmic trading and automated risk management isn't going away. If anything, it's accelerating. Quantum computing is on the horizon, promising speeds that will make today's high-frequency trading look slow. Artificial intelligence is becoming more sophisticated, potentially making trading decisions that even their programmers don't fully understand. The secret systems behind Wall Street trading represent one of humanity's most complex technological achievements. They're faster than fighter jets, more precise than surgical robots, and handle more money in a day than most of us will see in a lifetime. They operate in a world measured in nanoseconds, where being a few feet closer to the exchange's computers is worth millions, where fiber optic cables are measured to the millimeter, and where risk management systems make thousands of life or death decisions every second. This is modern finance. Not the Wolf of Wall Street screaming into a phone, but engineers and mathematicians building systems at the absolute edge of what's technologically possible. It's a world where split-second timing isn't just important, it's everything. And the next time you check your investment portfolio or hear about stock market movements, remember, behind those numbers is an invisible infrastructure operating at speeds that would have seemed like science fiction just a generation ago, protected by automated systems that prevent chaos on a scale most people never even hear about. The markets you think you know are just the tip of the iceberg. The real action? It's happening faster than you could ever imagine in places you'll never see, run by systems that never sleep.